Hey, it's Richard with Matthews Wealth Management. We're going to go over August 2022 as far as what the Fed's doing. So first thing we're going to look at this time is going to be the balance sheet. The first thing you'll notice here, there's 8.8 trillion still on the balance sheet, but this is big. This is actually $87.460 billion worth of bonds. That would be treasuries, high yield, and then most importantly, mortgages. I think that's going to be interesting moving forward, that have been sold back out off of their balance sheet into the market. And so what that accomplishes is that $87.4 billion has now been put back at the Fed. It's technically liquidity. However, the whole purpose of quantitative tightening here is to destroy this currency, right? That's the whole point of the battle against inflation, if you will. So $87 billion, that's a lot, right? So that is effectively lowering their balance sheet negative 0.98%. So almost 1% done in 1 month. Okay. Wow. So at the same time we're raising rates, we're also doing this. So that's the thing that, you know, I'm watching a lot of talking heads and people in the world of finance, and what's being discussed is the positive correlation between stocks and bonds. Well, not only is there interest rate risk in the fact that new bonds are coming out issued at a higher interest rate, but we're also starting to flood the market with $87 billion worth of old bonds that really aren't worth that much. Honestly, if you've got a treasury that was paying 1%, and now you can get one that's paying close to 3%, you just lost 2/3 of the value. So how much of this total balance sheet will be exchanged for cash? It's not going to be dollar for dollar. So we're going to have some permanent inflation, some permanent increase in overall money supply, just based on the fact that they bought these bonds at a very low interest rate and locked that in either to duration, which means they let them mature, and there's a whole schedule of what we look at for that, or they sell them and liquidate them in quantitative tightening. Hopefully at this rate, I think, what was it, in July or June? It was June, where we saw a negative, and I think it was a very small little negative, but I guess that's pretty substantial, right? Who would have thought that $87 billion is less than 1% of what they've got to do? But wow, zeros are hard, aren't they? I mean, they really are. It's hard to, I mean, even for us, we see trillions, billions, millions, and those are factors of 3 zeros added to the end. And when we talk percentages, it's really only 2 zeros. So it's a big difference here. Just wanted to start here on balance sheet to illustrate this, but you can go back to that's the 1 month change. Year to date, we're still increased. So we haven't even gotten to where we were before this year. This time last year, we've increased balance sheet by almost 6%. And since COVID lockdowns and real tightening, economic tightening, we're up still 111%. And most of that $4 trillion there was from mismanaged mortgages again. So let's just keep doing this, I suppose. Let's jump over to money supply, because this is supposed to be helping with money supply, right? Money supply is you know, the monetarist way of looking at inflation. The Austrian way is M2 and time. But M2, that's strange. M2 grew. So we destroyed 1% or sold 1% of the balance, and M2 went up. Okay, so, oh, got to change this. We can't use a green marker because that's bad news. So we have increased 0.19%. So 1/5% increase. So this was supposed to help with inflation. Do you want to know where that comes from? Congress. That is deficit spending, the real source of inflation. They wouldn't have had to do all of this if Congress didn't tell them to, right? Respect to the independence of the Fed, that's a can of worms. If you know me, you know how I feel about the Fed. And if you've watched these videos, you should be figuring it out without me explicitly saying it. However, whoops, we increased $41 billion in circulation over this last month. So yeah, not getting there. Plus rising interest rates. So whatever, interest rates are going to destroy the economy, right? They're going to lay off. That's what they're looking at, is the unemployment number, which is not really growing. We've got kind of peak participation that's falling off. We've got peak productivity that's falling off, and peak unemployment, which means nobody's looking to work. Wonder why? Student loan forgiveness. Good job, Congress. Congress. We wouldn't need a Fed without Congress. Go look up the origins. Anyway, we're up since this year to date. Not bad, right? But oh goodness, that's a big chunk of that just happened in the last month on money supply growth. And then you jump to the 1 year, surprisingly similar across the board. And then what's inflation going to top at? Right there, been saying it all along. Now, you can see a lot of expenditures are way above this 40%, right? As far as core PCE, we're mid-September. It's been hectic. Sorry I'm late with these, but core PCE came in higher than expected. Overall, CPI was way above consensus, but down a little bit. So we can talk semantics all day, but sticky inflation is always going to be based in money supply over time. So here we are, August 2022. That's a good move. Not enough compared to what we spend. Is that Ukraine? That might be Ukraine right there. How's that going? Whatever. We'll be back at the end of September, probably mid-October again. It's just a busy time of life right now. But yeah, we'll keep watching these as we have for a couple of years now. And I'll quit beating the dead horse maybe, but it's still kind of kicking. All right, next time we'll see you.